Good day and hello everyone. We are on topic 7, financial planning, short-term and long-term. Before we move, let's have a flashback. What have we learned so far? In previous title topic, we have learned types of resources obtained by a venture, its revenues and expenditure during the early stage. Then we also have learned, right, how to measure financial performance through the use of three basic financial statements like balance sheet, income statement, cash flow, and who use this statement and what does this statement record and measure. In addition, you also have learned the financial ratios techniques, several financial ratios techniques in order to evaluate the operating and financial performance of a business. And you also have learned what are the three basic ratio analysis techniques to benchmark your performance with other business, right? We have three types of ratio analysis techniques. There are trend analysis, cross-section analysis, and industry comparables. So you have tested your knowledge through Kahoot quiz in our previous lecture. All right, now we are moving from startup stage to survival stage to a seasoned firms in a venture life cycle. The venture needs to quantify how to survive its current business operation and for the future. It's not that you have to measure the current business performance, right? It is important for a business, for a venture, to quantify how is the company, how are they going to survive in the future. Therefore, they need to plan, right? The financial planning involves two types of planning. There are short-term planning and long-term planning. The short-term financial planning involves cash budgeting and projecting financial statements. That means how it helps the entrepreneur to anticipate. To anticipate means to expect or to plan cash shortfalls or financial distress, right? Therefore, the short-term planning is very important so that the entrepreneur knows when they will be run out of cash or when their business will be experiencing a financial distress. The second planning type is long-term financial planning. This planning involves systematic forecasting for additional financing needed to support growth, for example, like sales forecast, sales growth rate. So these are the examples of long-term planning tools. So therefore, the objectives of this topic is you should be able to construct a cash budget, explain why projected statement of cash flows are important to entrepreneur. You should be able to understand the concept of sustainable sales growth rate, and you should be able to understand the process of identifying and quantify and timing of additional funds to support sales forecast. So that means when are the time that you will need additional funds for your business. So this is the purpose of learning this topic. Okay, now let's look. What is financial planning? Financial for the venture to survive financially throughout its venture life cycle. Right? Normally, financial planning will begin with a forecast of sales. Remember the exercise that I asked you to do for your business proposal to prepare a sales forecast? So that is example of financial planning. But that one is short-term financial planning because it involves weekly or monthly forecasts. Okay. For longer term financial planning, normally it involves 3 to 5 years of forecast for annual levels, right, of many variables. They will use revenues, profits, and investment in property, plant, equipment, and working capital. Okay, so that is the difference between short-term planning and long-term planning. Short-term planning, normally, as I said, it will involve a monthly forecast. Long-term planning, normally a 3 to 5 years forecast. Okay, so in terms of venture life cycle stage, those are doing the short-term planning, normally they are on a survival stage. They are still in a survival stage, right? Not more than 5 years and below. Not more than 5 years, I mean 5 years and below of a company age. But for long-term planning, normally the company is already at the rapid growth stage, right? They can prepare for their long-term financial planning. In terms of financial goal, right? The short-term planning, the entrepreneur normally they want to know, they will plan how much profit that we make, right? How much money that they will need in order to survive in the future, in the next few months, right? So normally, who's involved in the financial goals? There is their retained earnings from the business operation. That means the sales and income, as well as the angel investors who is going to invest in their business. All right. For long-term planning, the financial goal now is to create value through product innovation, manufacturing, and investment. Investment in property, investment in plants, in equipment, in working capital. So that is the financial goal for the rapid growth stage. So that's why they need to plan for the long term, 3 to 5 years or 10 years in future, because their goal now is to create value through product innovation. They need to add some innovation to create new product development. So they need to plan for the long term. Okay. In terms of financial planning tools, the short term planning tools is cash budget. All right. Then we have what else? Under cash budget, we have sales schedule, purchase schedule, wages, and commission schedule. These three schedule need to be prepared in order to prepare the final cash budget. For long-term planning, right, the financial planning tools are more systematic, right? This is to estimate the growth rate of the company in 5 years in the future, as in order to estimate how much money will the company need in the future, right? So how much money that the company need? We call it as a AFN, or additional financial needed. So why financial planning is important? Can you guess after my explanation in the previous slide? I think you already understood that financial planning is very important because it provides valuable indicators of the quantity and timing, right? How much money needed and when you will need extra money, right, to survive in a 5 to 10 years from now, right? The second one is why it is so important, because it addresses whether the venture can generate adequate cash to meet its coming obligations. Let's say after a company enter the survival stage, right? A company might might acquire external funding. That means from bank loan. So in order to pay back the money to bank, whether they need to plan their financial, whether there's enough or adequate cash to meet the obligations. That means to pay back the loan. Okay. The third one is to plan measures to overcome or avoid financial distress or cash panic. Right? Financial distress is what? As I said to you in the previous lecture, when you have negative cash flow, right? So when you plan for your financial, you should be able to overcome these problems, right? The issues of financial distress and cash panic. Okay. Then the fourth one is it is so important. Why? Because it's too critical to survive financially, whether the company need for cash injections. Cash injections mean extra money, or additional fund to be injected in the business if the business cannot survive, right? So what they plan to do in 5 years from now.